As we explore the possibilities of generating income from a substantial nest egg, prepare to be astonished by the potential strategies, insights, and revelations that could redefine your perception of retirement planning. In this exploration, we'll delve into unconventional approaches and eye-opening scenarios highlighting effective financial management's true power. Get ready to discover how a significant sum like $10 million can pave the way for an extraordinary retirement journey filled with unexpected twists and turns. It's a common misconception to believe you can entirely spend the profits from your stock investments, but this isn't a wise approach. The stock market has a track record of being volatile. On average, the S&P 500 returns around 10% annually. For instance, if you invested $100 of a $10 million portfolio in the S&P 500, you could expect an average annual return of $1 million. That might sound appealing, but it's important to remember that the market yields profits in only a few years. For instance, 2000, the index was down by 10%, followed by a 13% drop in 2001 and a substantial 23% decline in 2002. However, it experienced 5 profitable years until the Great Recession of 2008. While these instances are extreme, considering the average retirement period is approaching 30 years, you'll likely encounter market fluctuations. Inflation can pose a significant challenge for those who exhaust all of their earnings. While a $10 million portfolio might yield an average of $1 million annually, spending every dollar of that $1 million doesn't account for inflation. To clarify, the purchasing power of a dollar tends to decrease by around 50% approximately every 24 years. Presently, a $1 million income holds substantial value. However, after 24 years, that amount would be equivalent to earning $500,000 today. While still a considerable sum, it's crucial to recognize the substantial impact of inflation. For most individuals, the preference would be to experience annual salary increases rather than a decline in spending power. Each individual possesses a unique comfort level when withdrawing from their portfolio yearly. While utilizing all the profits might be acceptable in the immediate term, the consequences of diminishing currency value becomes evident as time passes. Specialists hold diverse viewpoints regarding the threshold for secure withdrawal, but an estimate of 3 to 5% is generally considered prudent. The principle of the 4% rule emerged from a study that ascertained the viability of withdrawing the specific portion from one's portfolio every year. In the initial year of retirement, this approach would yield $400,000 in earnings, with yearly adaptations for inflation. In the subsequent retirement year, the amount disbursed would be $412,000, followed by $424,000 in the third phase. This strategy is designed to minimize the possibility of encountering difficulties, even in severe market downturns. Although the 4% rule of thumb is widely utilized, it has some different sources for its justification. It presupposes that your portfolio is evenly divided among stocks and bonds. However, some investors may prefer a higher asset proportion. Dave Ramsey, who takes an exceedingly risk-averse stance, warns investors to avoid bonds entirely. Instead, he recommends spreading your investments out evenly between growth and income assets, emphasizing aggressive international fund development. He contends that bonds' low growth potential and high risk make them unattractive investments. Surprisingly, someone who proposes using cash to purchase rental homes offers this viewpoint. The percentage of a portfolio invested in stocks can also be calculated by subtracting the investor's age from 100. According to this calculation, a person of retirement age, or 70, should invest 30% of their money in shares and 70% in bonds. The danger and possible reward from investing more heavily in equities increases directly. The 4% withdrawal ratio is based on a retirement lifespan of 30 years. That, however, may need to be revised for people who wish to retire prematurely. The probability of outliving one's retirement savings if one retires at age 40 is higher if that person lives past age 70. The difficulty comes from being unable to predict how many years one's retirement will continue and how long they will depend on their savings. Retirements that last 40 or 50 years require careful planning because knowing how much money you can safely spend is difficult. People of means nevertheless worry about their financial security. According to the Social Security Administration, if you're 65, your expected lifespan is about 3 decades. Considering this, it's prudent to prepare for a long retirement. The worry about running out of money is extreme for those in their 70s, as they might be unable to return to work. Those who are physically fit and have few health problems in their families may have a better chance for a long life. People over 65, especially retirees, may have more time to prepare than the average 30 years. The average lifespan has increased by around 5% over the previous 30 years, which is something to think about. A withdrawal rate of 4% may be too high if you anticipate a retirement lasting more than 30 years. Retirement income affects Social Security benefits. Still, one might assume a high salary from someone with a $10 million investment portfolio. The maximum payout for a single person at complete retirement age is about $3,113 per month or $37,356 annually. This maximum benefit is available for those who have worked for 35 years and made at least $137,000 annually. A portfolio worth $10 million would generate $400,000 in annual interest and dividends for a total yearly income of $437,356. Only about 9% of this sum comes from Social Security payments. About $1,543 per month or $18,516 per year is the average amount of a Social Security payment. However, there are 3 types of investment accounts: Roth IRA, traditional IRA, or brokerage. Influences withdrawal taxes, making tax planning essential for those in higher income categories. A traditional IRA, which is subject to taxes at standard rates, could drive an individual into a higher tax bracket, perhaps 37%. Roth IRAs are ideal for individuals with substantial retirement income, but the annual contribution limit of $6,000 is unlikely to result in a $10 million portfolio. A conventional brokerage account typically limits permanent gains amounts at 20%. Although a $10 million portfolio might cover a $400,000 annual withdrawal based on the 4% rule, well-off people frequently adopt a parsimonious mentality. About 38% of their earnings are saved by the wealthiest 1%, with $152,000 set aside after spending $248,000, not counting Social Security. This approach facilitates a significant yearly income increase, sustaining the buildup of wealth. Indeed, careful economic administration probably led to the establishment of this investment collection initially. What potential financial opportunities arrive with a portfolio income of $400,000 and Social Security adding $37,000? A monthly expenditure plan of $26,000 is possible with an assumed 28% tax rate. Approximately $6,500 per month could be allocated to accommodation costs, allowing for a home valued between $1 million and $1.4 million. Additionally, you could add your garage with a pair of cars priced at $275,000 per vehicle. Leisure expenses could reach $1,300 monthly, enabling several tropical getaways annually. $10 million is undoubtedly a substantial saving, but this doesn't imply that expenditures will be extravagant. Even though a monthly income of $26,000 offers room for indulgence, wealthy individuals tend to persist in their savings habits. They might opt not to utilize the entirety of that amount. In conclusion, understanding the nuances of managing a substantial retirement portfolio is essential. The strategies and principles explored here can serve as a foundation for making informed decisions about your retirement income. Remember, while $10 million is a remarkable sum, how you manage and allocate it will ultimately shape your retirement journey. Stay informed, be proactive, and embark on your retirement with confidence and financial security. Thanks for watching. Until next time.